Hello everyone. In today's session, we'll cover basics of mutual funds and ETFs, which are exchange traded funds. First of all, we'll see what are mutual funds. So many times we see a TV ad that okay, invest in mutual funds, and with a disclaimer that mutual funds are subject to market risk, right? So we'll see what are mutual funds. So mutual fund is nothing but an investment vehicle meant for pooling the funds from the investors and investing in a predefined securities, right? So it is like you are not doing your own fund management; you are just giving it to someone who's got a predefined set of securities where they will invest. Okay, so it is like they are just pulling funds from the investors and investing in. So they could invest it in equities, or they could invest in debt securities, or they could invest in hybrid of both. A mutual fund can they can invest in equity as well as debt, so that will be a hybrid fund. Or a mutual fund could be for money market fund. Okay, the whole objective is to pool the money from the investors and give them better returns. So there could be advantages and disadvantages associated with mutual fund and doing your own investment. See, if you are doing your own investment, see if you are buying your if you got a fund of 1 lakh rupees, you can do your own investment. You can buy stocks, right? So again, for that, you may have to pay a lot of transaction charges. See if you are doing a lot of turnover. So with mutual fund, the charges are less, so you can save on those transaction charges. Again, the diversification risk is covered with mutual fund, as they will be investing in different securities. Okay, so if you're there is a saying, you should not put all your eggs in one basket, right? So if with mutual fund, the diversification risk is covered. Okay, and yeah, so again on the disadvantages side, I would say that for mutual funds, they charge fees for the asset management. So that could be one point extra load on the investor. And there is no option for you to customize. You cannot say that okay, buy 10 Infosys in my portfolio or in that fund. You don't have that option for extreme customization. You have to go ahead with whatever the fund is buying, because they are the ones who are they are the one who are deciding where to invest. Okay, so you only select from the prospectus whether it's a equity fund or hybrid fund or a money market fund. But once the fund is given to them, they will manage with their own discretion. Okay, so we'll see the high level structure of a mutual fund in India. This is more specific to India, but overall this applies to all the countries. So in India, it is more of a key level structure where, say, the unit holder is the one who is investing. So he's the investor. We'll see later on what do you mean by unit. And sponsor is the one who is starting the mutual fund. So to start a mutual fund, you need someone, right? So there are few criterias for becoming a sponsor. Like you should have a minimum net worth, then you should show consistent growth. You should be in this sector for at least 5 years, and you should have shown performance in this sector. So just to keep it simple, I would say that sponsor is the one who is starting the fund. So he is the first level. Second, then once sponsor, he will get in touch with SEBI or the regulator and will get the necessary approval for the starting of the fund. Once the approval are given, then the sponsor will create a trust. okay, and it will have trustees. So this will form the second level. And the role and responsibilities of trustees will include that your mutual fund is in compliance with the rules from the regulator. And then the third level will be for AMC, which is asset management company. So this is the core business. This is where the core business is happening for the mutual fund. Say all the unit holders or the investors, they have given money to the fund. So somebody has to buy securities, right, or do the fund management for that. So that fund management will happen in asset management company. So this asset management company would be for this mutual fund, or they can outsource it to the existing asset management company. So this is what the third level I would say. And then there are other entities like, say, custodian. The role of a custodian is to safeguard the securities. Say if this mutual fund is for equities, then the role of the securities will be to safeguard whichever securities are bought. Also, after the selling, say whenever there is a transfer of securities, custodian has to give a go for it. So usually whenever there is a incoming or transfer of the securities, custodian is the one who sanctions it. And then there is one transfer agent, which is mostly for the investor relations, say for filling out the application forms or sending them the monthly statements of the performance of the fund, or it could be anything. So it deals with mostly with the investor relations. So this is just a high level structure of a mutual fund. So here these are the unit holders and regulator. So everywhere in all the markets, either whether it could be capital markets or commodity markets, there will always be a regulator. So regulator will oversee the performance, whether they are complying with the rules or not. Because here, as the investors or the common man's money is involved, there should be someone who should regulate it, right? So all these entities will report to regulator. Say trustee they will comply with the regulator rules. So in this case, it will be SEBI. Even asset management company, they will comply with the regulator. So now we'll see what is NAV, or when you say net asset value. Okay, so say if you are starting a fund, say if you need 1 million, say if you need 100 million, if you are starting a fund with 100 million, okay, and if you are deciding that the number of units of this fund will be 10 million, okay. So the fund capital is 100 million and number of units. So number of units is you can decide, the fund will decide how many units it wants to divide. So it can divide into 1 million units, or it can divide into 10 million units. It doesn't matter. They will just decide a number. Say if it is in 10 million units, then what will be the price per unit? That will be your NAV. It will be 100 million divided by 10 million, which is 10. So you can roughly relate it with the price per unit of the mutual fund. It's nothing but a price per unit of the mutual fund. Now, there could be two types of mutual funds. Either it could be closed-ended or it could be open-ended. Closed-ended means the number of shares or the number of units will be predefined at the initiation of the fund. For example, if I'm starting a closed-ended mutual fund, so I will say that, okay, I'm planning to start a closed-ended fund with 10 million units. In this case, my units are 10 million units or shares. We can use it. We can use the same word. We can say that, okay, I'm starting a mutual fund with 10 million shares. Each share is having a face value of 10 rupees. So my initial, I would say that the face value is 10 rupees. So it means that I'm starting a fund with 100 million market cap. Okay, so this is a closed-ended fund. So usually this type of fund, they will have an initial public offering similar to stock markets. Like for stocks, we got initial public offering, which is for the primary market. Then what is it? When you create a fresh securities, you will do it through primary market. Same thing is true for closed-ended fund. You will do it through IPO, right? Which is a primary market. So once you have told that, okay, I'm distributing 10 million shares, each worth for 10, face value of having 10, and the total capital you are raising is 100 million. Say this is on the day one, and on, say, after 1 month, if this 100 million becomes 110 million, say on day 30, it is 110 million, then you have to calculate the price per unit, right? For day 30, what is the price per day for day 30? It will be NAV. 110 divided by number of shares you have distributed, so it will be 11, right? Usually this NAV calculation will happen on daily basis. Okay, so NAV calculations will happen on daily basis. So on daily basis, fund will see what is the current asset value. So in this case, the current asset value is 110 million, and number of units or shares they have distributed, which is 10 million, and hence you will get your net asset value. So the closed-ended fund, now say as a new investor, you would like to invest in closed-ended fund. How will you do it? Because they are not open. They have said that, okay, it's only at the initiation they have allotted the units. So to buy the existing unit, you have to buy it through an exchange. Okay, so to invest in a closed-ended fund, once the primary market or once the allotment or the IPO is over, you can do it through an exchange. And with mutual fund, there is always an NAV. Okay, so in this case it is 11. So in exchange, you may find the price of this mutual fund either higher or lower or maybe equal to this. So you may find the value in a stock exchange maybe 10.95 or 11.05. So in this case, if it is lower than the NAV, you can say that the mutual fund is trading at discount to the NAV. If it is higher than that, you can say that it is trading at premium to NAV. Okay. So now we'll talk about open-ended fund. So for closed-ended, you said that I am issuing 10 million units, face value is 10, I'm raising 100 million, and I will manage with 100 million for the entire period of time. With respect to my performance, my NAV will keep on changing. With open-ended fund, you are saying that, okay, I'm issuing shares of, say, I'm issuing 10 million shares with 10 as the face value. So the total is 100 million. I got it. Next day, in this case, your day zero and NAV, or you can say the face value is 10 rupees. Net asset value is 10 rupees. Next day, if there is one more investor who is willing to invest 50 million. So in that case, the fund will say, okay, you invest 50 millions with us. So with open-ended fund, once this investment will increase, they will create new shares. In closed-ended fund, we are not creating any new shares or new unit. So in this case, I'm getting a new fund for 50 million. Okay, so I will create new shares according to that. See, here the assumption is on day second, the NAV is still 10. NAV is still 10. So I will create new units. So how many new units do I need to create? See, if NAV is 10, I got 50 million. So I will do the division and I will create 5 million new shares. Okay, so the primary difference is with open-ended scheme, you are creating new shares or new units as soon as the new fund is coming to the existing fund. And the reverse is also true. Say on the day 3, now we got a fund capital of 15 million. NAV is 10. For open-ended fund, NAV will be calculated once a day at the end, usually at the end of the day. Okay. Now we got a fund of 15 million. Next day, investor says that, okay, I want to have 7.5 million back. So in that case, what will happen? So if you take 7.5 million back, the fund capital will become 7.5 million. So again, assumption is NAV is 10. So you have to take 7.5 million shares out of the circulations. So on day 2, the number of shares were 15 million. So now it will become 7.5 million minus 7.5 million. So once the fund is coming out of the mutual fund in open-ended scheme, the number of units or shares will get destroyed. It will get reduced. Okay. In closed-ended fund, it will always remain same, say 10 million. Only the NAV or the price will change accordingly. And also NAV will keep on changing on daily basis based on the current value of the fund. As for this fund, as the fund is invested in securities, say stocks or bond, and stocks, say if it is a fund, mutual fund related to stocks, so the prices of stocks will vary on daily basis. So as the underlying asset is varying, the fund value will keep on changing. Say for this fund, if it is having a value of 10 million with 1 million units, next day, if the value of fund becomes 11 million with 1 million units, then your NAV will be equal to 11 million divided by 1 million, which is 11. So on previous day, NAV was 10. Now it has become 11. So it means that the current price per share of the fund is 11. So as a new investor, see if you are investing, say 1 million, then how many units you will get? It will be 1 million divided by 11 will be the number of units allotted to you, and these units will be newly created. As I mentioned earlier, for open-ended fund, as the new fund is coming, you will create new units. So those, how many units the fund will create? This many units, and this will be allotted to you. So this is more on an open-ended fund. So with open-ended fund, you can redeem. Say if you purchase the units from the open-ended fund, you can give it. Say if you want to take your money back, you can give the units back to the mutual fund. So this is one way of selling mutual fund, right? Say if you have invested 10 million with them, after 15 days, you are saying that, okay, I want to redeem all my units. Then you can give those money back to the fund and they will refund you the money. So this is the one way of selling your units to mutual fund. And the second way, it could be through stock exchange. So even you can trade your units on a stock exchange and you can get your money back. So you got two ways to sell an open-ended fund. Either you can return it back to the fund or you can trade it through stock exchange. Again, with stock exchange, the price per unit may be different, but it will be nearly the same. It will trade closely to NAV. If the NAV is 11, it will trade closely to NAV, maybe 10.95 or 11.05 based on the demand and supply and the future projection for the fund. So to summarize, mutual funds, they are just pooling money from the investors so that they can invest on their behalf for the growth. Okay, and they can invest either in equity or in bond or a combination of a bond, which will be a hybrid, or in a money market instrument or anywhere. So they will mention this in their prospectus where they are planning to invest. Okay, and advantages, it provides diversification. Say with mutual fund, you can get exposures to 100 of stocks, which is not, say if you are planning to invest say 2,000 rupees. With 2,000 rupees, you can either buy say 2 or 3 stocks. But if you invest with mutual funds, even you will get exposures to say 50 securities, but the quantity will be extremely less, right? So in that case, you are diversifying your risk. Okay, and this on disadvantages side, there is a fees associated with it, and you cannot customize within the fund. You cannot say that, okay, buy this security for me or buy that security. Once you are given the fund, it is on the fund to manage what to buy and when to sell. So for you, only what matters is, so as a mutual fund buyer, what you will have, you will only have number of units and you will see at what NAV I bought. Say if you bought 100 units at 10 NAV, next day, if say after 5 months, if you see that if NAV has grown to 15, it means that your investment has gone up by 50%. Also, NAV can go down also. It does not mean, that's why they say that the mutual funds are subjected to market risk. Say if you bought 1,000 units at 10 rupees, 10 rupees NAV, after 5 months, if it becomes 8, NAV can also go down. So what has happened? After 5 months, your investment has gone down by 20%. So NAV will give you what is the current value of your fund. Current value of your fund will be NAV multiplied by number of units you own. So that's why NAV is extremely important. Okay, so now we'll see what are ETFs. ETFs are exchange traded funds. Okay, so these they trade similar to stocks. I would say that ETFs are exchange traded stocks which tracks an index or commodity or bond, equity, or I would say the basket of equity. So what it means that, say if I'm having exchange traded fund, so from the word itself we can say that it is traded through an exchange. So the first point is you should be able to buy an ETF through an exchange. For example, it could be through NASDAQ, NYSE, or in US context. In Indian context, it could be NSE, BSE. So exchange traded fund are bought and sold to exchange, and it tracks the performance of, it could be anything. It could be index, commodity, bond, or a basket of equities. So, and they are traded like shares. Okay. So say if I'm having an, we'll take an example of an ETF for US market, SPY, which is the spider ETF, most commonly traded ETF. So what SPI does is it tracks the performance of S&P 500 index. So what does it mean? That SPY is an exchange traded fund whose value is based on the underlying 500 stocks. So in this case, we are considering a basket of 500 stocks. The value of this fund will be based on S&P 500 index, or the composition of S&P 500 stocks. Okay. So these will be traded like a shares. Let's say current price of SPY is say around $243. So if S&P index, S&P 500 index goes up, then this exchange traded fund will also go up. So now there would be one question, like what is the difference between exchange traded fund and a mutual fund? Because we could see a lot of similarities between mutual fund and exchange traded fund. Mutual fund, they are just pulling the money, and say if they are, if a mutual fund is a mutual fund can also invest in an index fund. Say if there could be a mutual fund which is for S&P 500, then what is the difference between ETF? So for mutual fund, we got a net asset value calculation, which is happening on daily basis. But with ETF, there is no such thing as net asset value. There is no such thing. We are not doing a net asset value calculation. It is just a purely a share. It trades like a share. So whatever it is, you just show. It will just it will be traded in an exchange like a share. And with mutual funds, there will be there would be lesser liquidity than an ETF. ETFs are extremely liquid. When I say liquid, it means that you are able to buy a lot of quantities of ETF easily through the market, or you are able to sell a lot of quantities in market. With mutual funds, when you say the liquidity is less, it means that you are not able to easily buy a lot of units of mutual funds through an exchange, or you are not able to sell a lot of units of mutual fund in an exchange. Okay, so the primary, so we have seen two differences. One is there is no NAV calculations related, and the liquidity is high. Yeah. And SPY, so if you need to know more about it, you can just search for SPY, and you'll get to know what are exchange traded funds. So there's a lot of similarities between ETFs and mutual funds, but they got their own distinction also. Also, ETFs, they could also be based, as we discussed, it could be based on multiple assets. It could track equity, or it could track commodity, bonds, or an index. Okay, let's see what I meant when I say that ETFs are more liquid than mutual fund. So we'll consider one example where, say, the NAV is 10 for a mutual fund, and for ETF the price is also 10. ETFs will not use the terminology NAV because it is only applicable for mutual fund. But there are a lot of similarities, so we can take a scenario where mutual fund NAV is 10 and ETF price is also around 10. So we have already explained we already seen the concept of bid and ask, right? So this is usually the book and the exchange. You could see that for if there is a mutual fund which is traded through exchange, okay. So usually we have already seen that, okay, the open-ended fund, you can trade it through exchange or you can sell the units back to the mutual fund, okay. So here the scenario is it is traded through exchange. So you can see that the because of the lesser liquidity, the buyer is saying, I want to buy this mutual fund at 9.5 rupees. The current NAV is 10. Seller is saying, I want to sell it for 11.5 rupees. And the quantity I want to buy is 25. Seller is saying, quantity I want to sell is 50. So here, the low, this will be 20. So here, the highest bidder will be on top, and the lowest seller will be on top, as it is the price-driven market. So you can see here the difference between bid and ask is around 2 rupees, right? Which is what 20% of the price. So you can say that the spread is higher. And if you want to buy this mutual fund with say 200 quantity, then how can you buy it? You have to purchase this guy, some amount, say 80 out of this guy, right? So to purchase a big amount, you are not able to do it easily. You have to swipe out the offers. You have to go till this guy, right? So if you want to buy 200 units, you have to take price till 13, which is quite high, as the current price is 10. And when we say that something is liquid, it means that you should be able to get in. Get in means you should be able to buy and you should be able to sell with minimum spread with more quantity. In case of ETFs, as these are like shares and the liquidity is high, there are many, the number of units are more. You could say that the spread will be like 9.95 and 10.05. So it is only 10 paisa. Here it is 2 rupees. And the number, say the person who is highest bidder may want to buy. You will find a lot of buyers on this, like say here 3,500 quantity, here it is 4,000 quantity. So it means that even if you want to buy 2,000 quantities of this ETF, you should be easily able to buy it for 10 rupees 5 paisa. So this is what a liquidity. There's a lot of liquidity. You can easily come, you can easily buy 5,000 quantity, you can easily sell 10,000 quantity. But with mutual fund, the liquidity is less. Okay, but again, both are doing it. So here for this mutual fund, they are just pulling the money from the investors, investing it in equity, or could be debt or any underlying asset, and providing the returns. With exchange traded funds, they are just tracking the performance of equity, commodity, or debt, and based on the fund's performance, the price is getting fluctuated. Either it is going up or down. Okay, so we have seen mutual funds and ETFs. So Schwab is in Charles Schwab. We do a lot of. We got many applications which are related with mutual funds and ETFs. So you could see a lot of funds like say index pools or this kind of stuff. So mostly these are just the customization within that. So say when I'm having an equity fund or a debt mutual fund, so within that I can have multiple plans also. Say if it is the conservative fund, so in that case my exposure to bonds will be higher because bonds are less riskier, right? So say if there is a mutual fund having a scheme of conservative fund, it means that mostly they are dealing with debt securities. It means that 70% of the fund allocation, say if scheme is conservative, from the word conservative we can say that it is a risk averse scheme. So how can you minimize the risk? As we have already seen, bonds are less riskier. So I can have a fund, say if the fund is 100 million, I can keep 70 million in bonds and 30 million in equity. So this is how I'm minimizing my risk, because I'm keeping most of my exposure on fixed income or the bond side, which are safe. And many times we hear that, okay, invest in growth scheme, right? Have you heard of growth scheme? So from the word growth, what do you mean where the exposure will be? In growth scheme, usually the exposure is like 70% equity and 30% bond, reverse of conservative. So bond scheme, they are steady, they will give you consistent returns, and growth scheme based on the underlying market performance, say in this case equity will give you returns. Say the equity returns are 30% for a year, you will get better returns than the conservative fund. But the reverse is also true. If the equity market is down by 30%, then a growth scheme may not perform well. So based on your risk appetite, you decide where you want to invest, whether it's on the conservative side or conservative fund, conservative scheme, or the growth scheme. And there could be also balance scheme. So these are just the customization which are available. So these will be told to the investors that, okay, we are planning to have this kind of schemes. If you are interested, you can give your fund and we'll manage and will provide you returns based on that. Okay, thank you.